This is the advanced session, as the schedule suggests. Okay. Okay, sorry guys. We're actually trying to open up a document right now, which is why I'm a bit preoccupied. So I'll show you my screen in a moment. Just make sure you have something to write with. Okay. And you understand the basic housekeeping rules, right? Housekeeping rules go as follows, right? Firstly, everyone is going to be on mute during the session. Okay, this is just to ensure that. Okay, this is just to make sure that we are all audible. Well, I'm basically audible at the time of during the time of the session. Now, if you do have a question, what you need to do is just basically click on the raise your hand button. It looks something along these lines. It looks like this, right? This is a PDF reader, Adobe Acrobat or something, but it looks a bit something like this. So it actually has a hand where you can actually raise it, and what you need to do is just click on that hand, and it's going to raise your hand. I'll be able to visually see it on my end, and I'll unmute your mic. Just make sure you have join audio clicked as well. Okay, just make sure you have join audio clicked, and that's going to allow you to speak when I ask a question. Okay, and it's going to allow me to sort of like have a conversation with you, respond, and it just makes things easier. However, if you can't manage there, what you can do, or if you're a bit shy, I don't know, what you can do is just you take the phone, whatever device you're using, just type in your question, and I will respond to it. Firstly, I'll actually have to repeat your question in order for everyone to be on the same page, and then I'll proceed to answer the question, and we can just communicate like that back and forth. So those are the two ways for you to actually ask a question, and then right at the end, I'll leave some time, okay, for everyone to ask a question, so like a free for all, if you would, and that allows us to sort of like get everything that we've been avoiding during the course of the session to just focus during the end of it. Right, so today we are doing our advanced session, right? So this is the second session of this week. The last session we did was on Tuesday for the advanced guys, and we were actually looking at moving averages, right? We explained the detail, the reasoning behind us, how we use moving averages and how we take advantage of moving average bounds, use it as support, resistance, and there are videos that I've done previously in that, and they are also in the YouTube channel as a playlist. I think it's labeled advanced playlist. All right, I think I just labeled it advanced playlist. Just going through to the YouTube channel and just search for it somewhere there. Or just going through to the Telegram channel. Just scroll back a bit into the earlier posts, and you'll be able to see it. Probably 3 weeks ago rather, I created that. So just go into that. So up until now, we've done candlestick patterns, right? So we've done candlestick pattern. We've taken a look at the Fibonacci, the retracement tool. We've also taken a look at the moving averages, and now it's time for one of my favorites, which is the big figure. Okay, I'm kidding, guys. Don't really have a favorite. Right, but the big figure is actually something very simple and straightforward that allows us to dictate, or rather have a predetermined, so like stop an entry into a market, obviously before it gets there, right? So it's a psychological level. I'll go into detail about its effects, and then if we do have time during the course of the session, we'll pass through to the MT4 platform, and we'll actually look at live examples and look at it from a practical standpoint. Okay, so round number. Now in figure 1, okay, this is figure 1. We have this price chart with candlestick removed, and only the prices going down on the right hand side, right? So these are the prices. Let me just try and zoom in to 100, 125. Let's see. Yeah, I think 125 is fine. Okay, 125 it is. Okay, so on the right hand side, I think this is the euro dollar, right? So this is the euro dollar on the 1 hour time frame. Obviously, that is basically irrelevant at this point. But you can see on the right hand side, we have prices going down, 1800, 11750, 11700, 11650, 1600, 11550, and 11500. Okay, now one thing these prices do have in common is that they are round numbers or big figures, and these, as we'll find out during the course of the session, are very significant. Okay, these are significant in the short term, right? And they can be very significant also in the long term. Okay, now between these prices, there's an actual 50 pip increment. Okay, so from this point to 1650, obviously to 1600, it's 50 pips, and another 50 pip drop is to 1550, and another 50 pip drop is to 1500. Right. So the reason why we look at these round numbers, so let me just plot in an example here. Okay, this is acting berserk right now. Right, let's just go to a blank area. So let's say we have price level here. Right? I like to use the Euro, USD, and South African Rand, obviously, because it's much simpler for everyone to relate to it. And boom, let's just say we have that 16, 15, and 14. Okay. Now, in its basic and most simplest sense, the big figure or the round number acting as a psychological support and resistance means that once price, let's say the United States dollar versus the South African Rand, I mean, we've pretty sure we've all seen that on the news, and we sort of like have this arbitrary number in our heads of what the price of the South African Rand is to the United States dollar, right? Fair price would probably be around 14 Rand. Unfair price probably at 12 if we see in our lifetime the South African Rand towards versus the United States dollar at let's say 10 Rand or 9 Rand. Okay, now that would appear like the United States dollar is actually undervalued. Hence, we'd be sort of like in our minds expecting a bit of a push to the upside. Now, every time it rises, let's say to around 16 or 17 Rand, we know it's a bit overpriced and it will come back to sort of like this, its base, which is around 14 Rand and 15 Rand. Okay. So the reason why these big figures, we have this sort of like emphasis on them and interest in them is that institutions also use these major areas, and therefore we can safely assume that there is a pretty substantial amount of liquidity, right? There's a lot of trading going on. Once the United States dollar versus the South African Rand gets to 18 Rand, we know that there's probably going to be a lot of liquidity around that area and a lot of trading activity going on. Okay. Now, these areas that I just spoke about, which is the round numbers, okay, the big figures, they're actually great where you can, because you can actually place your buy and sell stops, right? I think I've mentioned this already. And price will usually react around those areas or those levels, okay? Now, I think I've done this previously in a very long and exhaustive video where I showed how we can actually make some profits scalping short term, right? Using just the big figures. You don't use anything else. You don't use any prior analysis to get your trading decision. You just look at where the price is and you just look at where the next big figure actually is, and then you just set very small stops and very small take profits, and you'll be able to scalp effectively and just make some pips on a day-to-day basis. Now that it does require a whole lot of patience, right? Contrary to what you may think, and it does require a whole lot of mental capacity as well. I mean, you have to be really energized to actually achieve that. So I might go through it again at a later stage, but I mean, for today, we just need to make sure that we're focusing on how the big figure or the round number is influenced by major institutions, and therefore there's a lot of liquidity around there. So there's a lot of institutional sponsorship, or let me just say commercial interest, basically, which is there are big players who are going to buy and sell around those areas. Okay. Now, guys, excuse my document. I mean, it's not perfectly made. So I think I skipped, boom, figure 2. Right now, this is the same chart, right? This is that Euro USD, but now let's just zoom out just a bit so we can see the entire document. Okay. Now this is figure 2, and in figure 2, instead of the candlestick chart, all right, the first figure 1 didn't have anything on it, and figure 2 I just drew in some lines to actually give you an idea of how the market would travel between these very potentially lucrative areas, liquidity areas, and it goes a little something like this, right? So the price breaks down from that 1750 level, boom, right, and moves below 1700. Now, what you need to understand firstly is that what happens here, okay, is what's gonna sort of like influence what's gonna happen next, because at this 1700 level, right, at 117, there are institutions, right, watching the market saying, all right, if the United States dollar or the euro versus the United States dollar breaks below that 1700, okay, then I want to be a short seller. Okay, so if the price moves below this level, okay, I want to be a short seller. Therefore, I'll place my sell stop somewhere around there. And if it gets my sell stop, then I would anticipate at least a drop to, let's say, 1650. Right? Might even have a much more lucrative take profit area, depending on the time frame that whoever is going to be trading is trading. So, but what you need to understand is that below the 1700 level, there are a lot of sell stops, potential sell stops that are lying somewhere beneath there, and therefore the market will sort of like be attracted to that. And there's that knee-jerk type of reaction I usually talk about, where if the market pops below a very significant level, okay, and there is a lot of buying around that area and a lot of selling, you might see the market push up, right, which is what we call a retracement, and then continue to push down. Okay. Now, next, what would happen is, since there's a bunch of traders who actually went short below the 1700 level, okay, naturally the market would want to pull back and get those guys who are in the right directional bias to get stopped out, right? So let's say you went short here, right? You went sell, boom, just below this level, and you placed your stop loss at 50 pips. Right? The market comes in, boom, reaches your stop loss, and then heads in your direction in any case. Okay, so that happens a lot. Okay, and it's simply because when the price goes up and tags your stop loss, that simply means the sell that you actually had, you bought back up at this price, right? So the sell you were holding turns into a buy, right? So you exit by buying, and someone needs you basically need someone to sell back to you at that particular price, and the big players come in and start shorting again at that particular level. Okay, so at that swing high, that's when the big players, the large money, the big money, the big kahunas, that's where they actually come in and start shorting somewhere around that area, right? Just as when you're actually exiting the market, and which is why a lot of times if you were right in the trade, right, or the direction rather, and the market tagged your stop loss, the way in which it moves away from that stop loss of yours, or where that stop loss was after it's gotten you out of the way, in a sense, then it's sort of like a drop. Boom, market drops lower and pulls back in. Okay. Now, swing low here is more or less the same thing. There are guys, or there are traders, right, whether it be institutional, commercial, or retail, who are or who do believe that the market is still going down, right? So they might chase the market going down just as it rebounds, let's say from 1650, right? Boom, place a sell right there, sell stop rather, right there, and market comes in, triggers that sell stop, and moves in that opposite direction again, usually about 50 pip increment, and tags the stop loss, which was here, before it moves away. Now, what also happens here is that for the guys who were like, okay, if the market does break up again above 1700, then I'm going to be a buyer, right? So it just activates the buy stops at this area as well. Same thing happens, and eventually breaks below, swings below the 1600 level, okay, pulls back again, takes out the stop losses there, boom, assumes all the guys who's selling actually takes over their position, so they become short players at this place, at this area here, just above this 1650, and the market pushes down again, right? Just below. Usually it's just below or just above, or it just touches and then swings up again. Same thing happens. Some guys will be looking to buy when the market rises above 1600. Okay, so when the price goes up above 1600, there will be buyers, right? Which will then be pulled in the opposite direction. Okay, and yeah, the cycle sort of like continues, right? It's a repetitive cycle, and if you look at it consistently, or you look at it extensively, you'll see the consistency in which I speak of. Okay, so let's just get rid of that. So this is how the market will move. I talk about the old adage all the time. The market moves 2 steps forward and 1 step backwards, which means if the market runs up 100 pips, it's going to pull back at least 50 pips before it continues the run up. It doesn't go like straight up, right? It doesn't go like this. You buy and then the market just goes straight up to your take profit, right? Even when you're in the right direction of bias, right? Especially when you're in the right direction. The market will do this, it's going to pull back, and then it does this, and it might go this way, it might go that way, and 3-4 days later, the market is still somewhere around here, okay? But there's just your take profit, and sometimes if you hold on to it, right, most cases, you hold on to it, it's going to eventually get to that take profit. But it's sort of like when you're wrong in the direction, right? Let's say you buy here, and your stop loss is somewhere there. It feels like the market just drops towards your stop loss, takes you out, right? Boom, gets you out the game. It's simply because you were buying where you were supposed to be selling, or you were selling where you were supposed to be buying. So it helps us as well, in a sense, to piggyback some of the big players or the big money, which can always be very helpful for your P&L. Okay. All right, so I've already explained through how price will typically move in a perfect world, basically, and how the psychological support and resistance structure actually helps in providing liquidity, because guys will be looking to place buy stops and sell stops, looking to get in, they'll place their stop losses, they'll be looking to get out at this point. So it makes it a very liquid area in relation to other parts of the chart, for example. Okay. Now, I don't know if. All right, so I got my pictures mixed up quite a bit there. Now, figure 3 actually shows what we've been talking about, actual candlesticks. So the price has this movement about it, right? When it gets to close below the level, you can see where the stop losses or take profits would actually be, right? Now, if we were looking at this from a very practical standpoint, okay, see the market swing low below that 1750 level, right? And push back up right above 1750 again. Obviously, that's gonna sort of like induce the buys on the upside, which will then prompt the market to fall back again to the downside, right? Activating, you see, just barely touched, just barely went through 1700, and the market then just pulls away from that swing low again. Boom, right? And barely touches that 1750, pulls back down, just touches that 1700 again, and market pushes back up, closes above 1750, which might prompt traders to go long at this area again, and the market drops. You can see very aggressive. 1, 2, 3, 4 red candles in a row, and the market goes into consolidation again. And we have somewhat of a pull back to the upside. Obviously, that's not one of the ones that I would be trading. But you see a swing to that 1650 level, and market pulls up from that 1650 level. Okay, probably catching the stops on the guys who decided to go short right at 1650, and then continuing in that direction in any case. All right. And then I do believe that this is where the market ended off. And this has been just a single week, I believe. Yeah, because I think I was using the 1 hour time frame on this. All right. So this is what we'd like to actually see when it comes to focusing on the big figure or the round numbers. Now, it's not always going to develop like this, but you want to be in the trades where it actually does follow this sort of pattern. Right? If you're using this strategy, then you want to be in a scenario or in a situation where every time this does happen, you're available, you're there to take advantage of that occurrence. Okay. Now, right, I think definitely I've got my figures mixed up. Now we're looking at where the actual sell stop and stop loss would go. Right. So let's just move there. Now a lot of guys have been asking me regarding stop loss, whether I should use it or not, and I've always responded with the same sort of like monotonous response. Yes, if you want to be a trader long term, you definitely need to use a stop loss. However, a stop loss isn't something that you put there because you're afraid of losing too much. Okay, it mustn't be that you're afraid of losing too much. It's just because if you're looking at stop loss as something to limit, let's say, the dollar amount, or you set it according to the dollar amount that you're willing to lose, then you're probably going to have very tight stop losses, which aren't very, how can I put this, profitable. Okay, so it doesn't help, although when you're thinking about it logically, if you have very tight stops and very large take profits, then it would make sense that when you're right, you're going to make a whole heap of money, and when you're wrong, you're just going to be wrong just a bit. But a lot of times you might be right about the direction of the market, okay? But because you had this situation where the stop loss was too tight, the market gets you out the trade, right? On a small loss, right? But the bigger loss is that you missed out on the opportunity to actually make some money. Okay, so the stop loss is primarily, for me, determined by an area where I feel like the market will not actually reach it. Okay, now you do need to factor in risk control, but the stop loss is predetermined by an area where I'm like, okay, if the market does reach that stop loss, my stop loss at that point. Okay, as an example here, I'm like, if the market reaches this area here, then I am definitely wrong, and this is not a market that's actually going to be dropping. Okay. So the market duped me, or I duped myself rather, and therefore, the market just does its thing. Markets are impersonal. They don't care about you. They don't care about me. They just move. So when I place my stop loss, it's not like there's any single person just sitting there watching, but it has to be an area that is actually safe for you to place your stop loss. So when you know your stop loss gets triggered, you are completely wrong. You can move on to the next trade. Okay. Now, if you're looking at where the sell stop would actually go, so in a scenario where we're just looking at the round numbers, the big figures to make trading decisions, right? You would set a sell stop and you'd set a stop loss. All right. Let's just use sell stop. Okay. Now, the beautiful thing about using this is that you can actually sort of like have an idea of where you'd like to see the market come into way before it gets there, right? As opposed to the rush that a lot of people experience when they open up charts and then all of a sudden they start seeing trade setups and they have to trade, and by the time they've looked, it's only 9 a.m. in the morning and they already have 10 or 15 trades, running, right? So you just want to avoid that by letting the market sort of like come to you, right? This helps you to do so, to plan your trades in advance and to let the market come to you. So let's say the price is here just below 1650 and we'd like to see a pullback. Now, this will obviously not be the only thing that you actually look at. If you've gone through strategy 1 already, you know all the other things that we look at. But if it's just the scalping part of the strategy, then you can sort of like make your adjustments in terms of stop losses and take profits there. Okay, so if you see the market push up, right, we're gonna place our sell stop right at 117 even. Okay, right, 117 even. Our stop loss goes at 1750. Boom, there we go. Okay, it's an area where I feel like the market, it's actually unreachable for the market to just tag my stop and then go in the opposite direction. Right, if it does, then I'm probably wrong. But if it doesn't, then I make some money. So you place your sell stop, right? You set your limits, or rather the volume, okay? And you just place your sell stop there. And when the market comes in and triggers your sell stop, okay, now you got an active position. What you need to do then is to obviously manage the position. Right now, you can do it one of two ways. Okay, you can trail, which is what I've explained, I think, so many times before about what the exact amount of pips. I think I even put a PDF in the Telegram channel earlier today that tells you how to split up trades and sort of like trail your trades to effectively manage them so they don't get neglected or whatever you want to call it. But in this instance, you have a solid stop, boom, there it's 50 and it's triggered. And if the market goes in your way, it does go your way, rather, happy birthday, you're making some money. But if it doesn't and it triggers your stop loss, you're out the trade. You just look for the next area. Okay, so that is the importance of those big figures. We will continue, I think, next session to look at more practical examples on the MT4 charts and how to actually plot the indicator, because this doesn't just pop up by itself, right? These round numbers just don't pop up by themselves, unfortunately. You have to install the indicator and make sure it's actually working, right, on the MT4 that you have. And then you set up your MT4 template, including this big figure indicator. Right. So every time you throw in the template, you'll be able to see where the potential round numbers are. Right. Then you can start working with it. Right. You can start playing around with it. It's actually quite interesting, especially when it's the first time you're using the tool. You just go back in your charts and you'll see how consistent the reaction to those big figures, those round numbers actually is when it comes to the market. So definitely worth taking a look at. But if you feel like this is more too complex for you to add to the strategy, that's fine. If you feel like it's okay as a standalone, you may do so as well, but only if you're using it on the shortest time frames. But if you want to do longer time frames, you need to have a bit more of analysis included with your big figure. Okay. Okay, guys. I think we have a few minutes left. So if you do have a question, now would be the best time to ask it. Okay, if you have a question, ask now or forever hold your peace. Okay. All right. If you guys don't have any questions, I'll just wrap up things here tonight. Now, what I will do is I'll send, if you didn't see the PDF, I think it's Signals ebook or something along those lines. Just check that out on the Telegram channel. Make sure that you download that, and yeah, just start checking out the money management that I put in there. It does also include a sort of like a template that guys can use in terms of account sizes, because I know a lot of guys who are, I don't know, they just can't wrap their heads around what I'm saying when it comes to what we did last week, Thursday. And they just want something that's going to be straightforward. Like, okay, this is how much I use in terms of lot size until my account gets to this much, right? Which is perfectly fine as long as you're staying within the limits, that 1%, that 3%, that 5% risk in your total account size. Okay. Okay, guys, I think we have about 5 minutes left. So if there are no questions right now, I will just end off tonight's session here. Okay, if there are no questions. I am aware that a lot of guys have been saying that they haven't received emails and such. So I'll just repost the PDFs in the Telegram channel. Also, what you need to do is just sometimes it goes through to the spam folder. Okay, the emails go through to the spam folder. Just go on through to the spam folder, or you can just search Anele. You'll be able to find the email if I've sent that through to you. Okay, so if I've sent it through to you, you'll be able to find it. If not, you can just go on through to the Telegram channel, but make sure you let us know in one of the WhatsApp group or one of the WhatsApp channels, and I'll update your email. And because every time I send emails, because I send some very interesting stuff, and I'll be sending a piece of software that is going to be very important for the guys going through to the advanced session very soon. Okay. Right. So I mean, with the advanced guys, what we're actually going to be doing, I think it's 2 weeks from now. So it's going to be very important that you get that. I won't be sending it via a Telegram channel simply because obviously not everyone is part of the advanced session, and it's just going to be very confusing to have guys who are downloading that and trying to figure that out while they're still part of the beginners classes. Okay, so I'll end off tonight's session here, guys. If you have any questions, just go through to WhatsApp, right? Or you can just talk to me on Telegram, on my Telegram number. Otherwise, just you guys enjoy the rest of your evening, and I will see you guys in the next session. And cheers, guys.